Hello and welcome to today's stream slash video. Of course, as a obligatory note that, of course, I do use Twitch as the recording end of as I'm recording stuff. Uh, so just because, right, if I'm going to record, I might as well stream it as I can export it over. So, get to mess around with Twitch analytics, right? Um, but anyways, today knowing that, of course, on a channel I like to hear myself talk. So today there's I want to talk about Aswath Damodaran, um, and this esteemed fellow is, in my view, is a really nice resource uh, for people to know about who frankly more people should know him than some of the people uh, who do get attention among, especially like retail or it's like regular people because of how his content is a much more open source and available. For example, on his NYU page, he offers a lot of resources. He includes the Excel files for various things. He actually offers spreadsheets. Like his course, like the sessions of the classes he teaches are available online on his YouTube channel. As we can see, here, like he shares a lot of stuff, right? Like his various class sessions. He talks about contemporary topics such as like capital moving away from the risk curve, like the Twitter acquisition or theoretical Twitter acquisition. Although likely to close, of course, given that it is kind of binding. Uh, and then, all right, very good useful tools for how to value an asset or a cash flow bearing asset. Of course, right, and of course, there's a caveat of cash flow because I suppose you can consider a Bitcoin an asset, but it doesn't generate cash, right? So you can't value it on a fundamental basis, right? So anyway, so at the very least, today is going to be wide ranging. I suggest, of course, signing up for his newsletter as it is very helpful. I like to get his various writings. Like honestly, like if you want to be lazy and Aswath Damodaran Big Tech. Uh, he give me a second. So the Professor Damodaran, if you want to be lazy, it's a very fun thing. Like he periodically values companies. And so if you want to be really lazy and just want to take his value, like his discounted cash flow of a company at face value, just want to take that, then he does it like 2 or 3 times a year. So like he revisits Tesla, he revisits like your FANG, the big five tech companies. He visits some IPOs occasionally. All right, excuse. Okay, got the link. Uh, Here we are. But yeah, I suppose looking at certainly I suppose like the actual quote unquote valuation of a company is probably a good introduction to like how granular and helpful Professor Damodaran's work is. Um, all right, FANG, of course, Facebook, Amazon, these fellows. All right. And like, yeah, his writing style is understandable, personable. Uh, yeah, yeah, honestly, like especially it's just really useful for anybody, but especially for people who don't necessarily have access to like, of course, like to like a finance curriculum, like if you're not a student, or to a top curriculum, or access to various resources like how to get a more accurate uh, weighted average cost of capital, and how to what's your discount rates, which can be very helpful for determining a discount rate on a company. Um, and so, okay, right. So here we can. This was September 2020, right? And yeah, if you like, yeah, if you want to be lazy, right, and just want and the good thing is like some DCFs can be a bit convoluted. Like sometimes like, they'll include like the three financial statements, even when you're kind of just gonna want to look at, the like growth assumptions, like just get like your free cash flow estimates, and then just get your upside downside. But of course, it is good to know like the actual inputs that are going into it and the underpinning the model. And so, yeah, and definitely like just like again like not many people will be as transparent or show you these things. There's like of course there's a lot of investing or finance substacks. Of course like the blogging the newsletter platform, but they oftentimes they won't include the Excel model, or they certainly won't show as much, because when you show as much, right, especially with this, right, like evaluation input. Another phrase for that, as Professor DeBoer himself would say, is that it's a prediction. And so naturally, predictions can be right; they can also be wrong. And so a lot of people, especially when you're trying to get someone to subscribe, to pay money to subscribe to your newsletter, or you want to establish credibility, you naturally then like there is the incentive to be a bit more cautious when it comes to disclosing or being fully transparent, right? Because naturally, with transparency, like it reveals you show mistakes. You might show some assumptions that some people might laugh at or find ridiculous, and but ultimately, but that's just the nature of a discounted cash flow or investing in general. Like you are making predictions about the future, right? It's forward looking, um, and so that's the name of the game. But again, for Demoterin, right, for a esteemed professor like himself to be as transparent as this, and it's like, and he links the contents so that it is available in Excel format, and you can twiddle with the figures and numbers. So if you need a DCF template, you don't need to sign up, sign up for a like a one of this, send your email. You just download his. Um, yeah, he does. It's it might not be the most interesting stuff per se, but yeah, I think like, he does give a good overview. And again, this is the evaluation from this is February of 2022. So of course there has been a lot more uh, uh, downward or lower multiples in for companies, of course. Um, all right, but then like Meta, undervalued. All right, IRR is not the most. It's a bit of an abstraction. It's I don't want to explain it improperly, but it's been a while since Finance 100. This is my corporate finance class, but generally higher percentage. It's kind of synonymous to like as I just mentioned, like your cost of capital, right? Of like, is it worth taking on a project? Is it worth to allocate your capital into a company? IRR is kind of a proxy as to like what your hurdle rate is, and if the investment will meet that hurdle rate, right? Just as if your cost of capital is uh, uh, if you are, I don't know, General Motors, and you're thinking about doing a new project, then your cost of like again to this like this abstraction, right? Because like the quote unquote cost of capital is like the internal metrics are different, right? But essentially it's a hurdle rate, or like that's kind of like the cost of just starting a project. And so naturally, if you're starting a project, you would like a return on said project, right? And so uh, and so IR is a loose from like the more of the like of like what your return will be in that same format of hurdle rate. Um, and you can see so ultimately, right? Like you can, of course, like you shouldn't take anything at face value, but if you want to, you can. And again, like for the relative transparency, he shows the cost of capital percents that he uses. Like honestly, like that's probably one of the biggest things because your cost of capital, right? Like if you just look up what is average WACC, weighted average cost of capital, right? You get a lot of different things. You'll have some people that say like your WACC should always be like in the teens or like double like two digits, and then some people say like, oh, you can just like some very weird DCFs or some very aggressive DCFs will be like will say just take like the Treasury 10-year or 5-year and just then like slap like 1 or 2%, and they'll give you like what they'll give like 4 or 5% discount rate. And so both of those extremes, like of course there's situations where they can be prescriptive, and ultimately a discount rate is it's more of it's like it's malleable, and so for Demoteran to give cost of capital numbers, I think that gives you, I think, if you want to build your own model, make your own assumptions about gross margins, um, and total sales, then that gives you the freedom to do so. And so ultimately, I think and that's kind of Demoter in a nutshell. He get like him having all these resources available. It allows you and me to to look forward uh, and make our own models, make our own projections, make our own assumptions. But yeah, and those assumptions hopefully are a bit more well guided or well supported, thanks to open source resources like this. Of course, you could also say that just buy Facebook, right? But of course, that's not the implication. And then he does I think ultimately like his how he talks about valuation and how valuation is how he talks about it in such like a way that like really shows like what because it's very easy when you're looking at a right like an Excel model to just be like, oh, you're just plugging in numbers and like to act in a way that's very detached. But Demoteran, Professor Demoteran, does really good the way he talks about it, the way he does it and expresses it shows that when you are valuing a company, you are telling the story through numbers. Like, why do you think 15 and not 5% sales growth, or why, or what like valuation story, right? Or is like your current gross margin sustainable? Do you have a competitive advantage? And so ultimately, like all of those things are implicit in your assumption, especially when like your model, like you're talking about pretty broad things. You're talking about total sales. Total sales, um, right? Especially for any company, involves involves a lot of things. Just saying total sales, like it's like if you're so what's your Apple? So you're selling hardware, but so that's part of your sales, but you're also selling software. That's also part of your sales, and and expenses, right? So what you have depreciation on some office buildings, but then you have capital expenditure as an expense because of you're building some working on some headsets. Excuse me. And so all of those things are ultimately like part of things, and I think for a lot of, including myself, I do kind of like I can tend to gloss over those and just like slap on some numbers that seem right, that seem reasonable, like decay over time, and then just slap on and then just use some Excel shortcuts, stretch it out for 5 years. Uh, but he makes the point of how it's not actually the case. He does talk about contemporary, more contemporary stuff such as markets. He has really helpful things on inflation. For example, and again, like none of his stuff is per se groundbreaking, It's not like it's Nobel Prize in economics, but to deliver it in such a concise, clear way and to make it open source. Again, not many people do it. I think, and Demoter, I think he points out things that can go unsaid, like this graphic of just like how inflation affects the company's earnings, and ultimately by extension, then the company's fundamental value, and by proxy, uh, the, the stock price of a company. Again, in the pyramid of downstream effects and how things, of course, there are delayed reactions and mechanisms, um, right? Of inflation, how it can affect pricing power, affect your input costs, and affect if you want to invest in future projects. So it's only around that number. It's like future inflation. If inflation is going to be chronically high, and Facebook's spending $10 billion plus on Reality Labs, which is the department in charge of Oculus, and their quote unquote metaverse projects, then if the cost if that project made sense when they started it, and like their again uh, and their internal cost of capital or hurdle rate was a lower number than it is now, because like your risk-free rate is higher now, then does that project still make sense over that time horizon? Like, maybe not. And so is that a good use of capital? And shouldn't they just be buying stock instead? Who knows? Maybe. No, no, I don't want to get delve into that. And here's what he says, right? Like risk adjusted discount rate, right? Cost of equity. If inflation's up, that means that generally means then that like your interest rate will be higher. And so why, if you can get 4% risk free, why would you take risk for 5%? And of course, risk isn't binary like that. Like Howard Mark, a quick segue to talk about risk. Howard Marks, of course, is a credit investor. He has his his Howard Marks memos, which are again not necessarily groundbreaking, but like just like like making his stuff available in the first place is helpful. And he also has, through being a Wharton graduate, he has Wharton makes public some of his talks at Wharton. So I think I think it's important. And so pretty much okay. I'm talking about risk curve, right? You have like the common conception of risk curve, and I agreed with his. All right, I agree with. He pointed out in his most recent talk at Wharton is that the common conception of a risk curve is kind of overly simplistic, and that the idea of a risk curve, right? If risk is X, return is Y. You take low risk, you get low return. You take high risk, high return. However, that's a bit binary. Just because you take on risk, it doesn't mean that you'll get a return, right? Just because you toss a $10 bill into the air when it's windy, that's risky. It doesn't mean you're getting a return. And then that's a very bad example. But it's not. You can't just say I'm taking on risk, therefore I'm gonna get a high return. Because no, like if you invest in a company that's like a pharmaceutical company, right? And it's highly dependent on early stage pharmaceutical company, and it's highly dependent on if the FDA trial works out. That's a lot of risk, but well, but then again, it is potential return. By the way, this just a y equal this just slope of one is a bit binary. And the point Howard Marks made, that Mr. Marks made, is that sure, you take on more risk, you should get more return. But he went on to say that risk doesn't mean that something bad will happen. It just means that more things will happen, right? And so like the risk, right? If you buy a treasury bond, right, like that's backed by the full faith of the United States government, um, there is no, or to say that there's no risk in anything is from a semantic point of view or a principled point of view, probably not something that should be said. But functionally, like a U.S. Treasury bill, there is no risk to again with that asterisk, there is no risk to a U.S. Treasury bill, right? And so what does that mean when there's no risk? That means that there is only one outcome, that you will get your money back plus interest. Whether it's a right, so say you get a 1 year, you buy a 1 year Treasury bill, you will get your money back in 365.25 days plus whatever interest rate or a coupon payments, right? You move up the risk curve and say you buy Take Two Interactive stock, right? So it's a company has earnings that can fluctuate. Uh, right, how much? So it fluctuates. The earnings per share fluctuates. The company can spend money well, or it can spend money poorly. It can acquire other companies. It can increase sales, decrease sales, right? So it's more risky. And just moving up the risk curve, right? And again more variance, right? Because um, right, what if sales continue to increase, or not sale, but ultimately free cash flow or earnings continue to increase, right? That's upside. You have more things, right? Treasury bill, T bill, only one outcome. Buying, say, Take Two Interactive, more outcomes, more good outcomes. Maybe you get maybe you get a five, the company, the share price appreciates by 5%, 10%, 20, 25%. Maybe the share price decreases 5%, 10%, all that, right? But right, so just from that, there's more variance, right? But but again, but your negative outcome is still, it's not absolute. It's not absolute to negative, right? In the sense that you do have like your and ultimately there is a company has assets, right? And so this company has a share price. So if they have 2912 in in cash, that is cash they have, and they have that many shares outstanding, you can just divide it out. And so theoretically, like, you're, I messed up the math, but pretty much like you have like your price, like number of cash per share that the company has, and so theoretically, the company could just liquidate and you'll get that cash, and that kind of acts as like your bottom ceiling. So like your variance is right, and then say you invest in like a pharmaceutical company or like an early stage startup, right? And so like tremendous upside, maybe it's next Google. You could also go completely to zero, or maybe you get caught up in some creditor issues, right? So again, so the risk curve is much more. So that's a bit of a segue, but just a relevant point. And in just talking in the sense that this entire video is just about really useful open source resources that are available completely free. Howard Marks, his so like there is no financial incentive for Howard Marks to make this stuff. Like literally, like if you are reading his stuff, you are literally you are not an accredited investor who Oak Tree Capital is gonna invest in the distressed credit for. Right, like that's not gonna happen. Demoteran, he's not selling a product. I suppose in a sense Demoteran is selling NYU, but you know his classes are he uploads them. Uh, all right, general principle, right? Think about incentives. So there's not much incentive for these guys. Who else? Okay, and okay, so a bit of a pivot. So hopefully from this you've seen how useful uh, the Motiverins work work is. I extremely suggest signing up for the Motiverins. At the very least, you can save this in your inbox. You can set up a folder and you can show this stuff. And so when you tell your parents, uh, and if someone asks you, man, why did my investment in Amazon? You can just find the Motiverins valuation and you can say, well, what price did you buy? What is your cost basis? And you can show them. You can download the Motorins model. You can just download his Excel, and you can show the person the Excel, and you will have so much credibility from having a fancy, wonderful Excel. Of course, these DCFs aren't necessarily the most advanced. They are not. DCFs are not the most advanced Excel things out there. So the Motorin extremely useful. Like dig around on his website, dig around in all of his open source tools. He has like cost of capital for industry. He has like equity risk premium for the country that like the country that the company is based in or has operations in. So all of which is again completely free, extremely useful. Howard Marks's stuff. Howard Marks's memos again incredibly like they again like the guy was around since like the since the 70s, and so he's seen a lot of market cycles. And again, like the way it's very simple. It's in the same way that like like Berkshire is like listening to like like Warren Buffett and Charlie Munger speak, and just like read uh, and just read like the transcripts of like their annual meeting where like just Warren Buffett and Charlie Munger they just answer questions. Um, like it's just good. It's just good to have. And so Howard Marks' memos, like succinct, interesting things that like at the very least like you'll it's good to be reminded of basic principles. And just as like the idea that risk is just means more can happen. Risk isn't bad or good. It just means more can happen. More good things can happen. More bad things can happen. Like that's all risk is. Again, very useful insight. The Motorin just like talk about like, the actual like purpose of valuation, why you should or why intrinsic valuation through a DCF is good. Like, what are you actually doing when you're doing that? Again, is useful, helpful. Howard Marks, Charlie Munger is like their talks, and like Chris, like don't have to watch the full annual meeting. Like find it. There are transcripts around. I'm using a guest history, uh, so I don't have access to my bookmarks and stuff. And I could switch over, but so Charlie Munger. Well, it's Matt Levine. He writes a free newsletter. Not a newsletter. It's like a daily. It's a lunchtime thing, and this stuff is if you want to covers a lot of ground. It's all finance related. He's a lawyer, former investment banker, or former lawyer, former investment banker, and he talks about a lot of things that are like finance business related. And the way he writes is very it's engaging to read, and he does cover a lot of ground that is interesting. So again, free to read. And lastly, there are more resources. There are more Substacks, but I'll save those for a future video, of course. But I cannot. I would be loath if I didn't mention Martin Shkreli. He's out of jail. The man is out of jail. Uh, and just as before, like he had those streams, and he engages with just as before he went to prison, like he has streams. Let me see if I can find him. But so much ago, it's been more of a, I suppose, but again, like people who, right, like 5 years ago, uh, all that, and so and he's on Twitter. He is active on Twitter. Like for example, he did reply to a DM I sent him. But I sent him a pretty wacky financial model when he mentioned like, can people send me some wacky financial models, and he replied. So yeah, that's pretty cool. So but he actually does engage, and in the sense that it's a rarity for people who know what they're talking about to to engage with to be willing to engage with random people, certainly online in a way that's viewable, accessible. It's a rarity to have. And of course, yep. And here's the link tree to Shkreli. I will include the links to all of like Damodaran, to Howard Marks's memos, Matt Levine's articles, to yeah. I guess I can't really link to I guess I could link to, like the most recent more about the Chartmonger's most recent annual shareholder meeting at Berkshire. I can link to that, and I can link to Shkreli's link tree. It's good to know that Shkreli also uses Linktree as I do. Of course, check it out. Join his Discord, read his subscribe to his Substack, again free. His TikToks are actually pretty funny. Uh, his TikToks are might cool. Oh gosh, can I? Gosh, okay, give me a second. Give me a second. Bear with me.
Prison. There were a lot of Hispanic prisoners.
Okay.
Every
You
time
should be able to
I
hear the
saw
desktop
them
audio.
around me, I'd see them look at me, and I'd kind of look at them. I said, that's right, I'm a maricon. Absolutely. I'm the biggest, baddest maricon in this place, bro. So watch what you say to me. You got that? I tried to learn Spanish in prison. There were a lot of Hispanic. I said, that's right, I'm a maricon. Absolutely. I'm the biggest, baddest. So I think it's really disingenuous.
And
It's another day in New York City. Let's get this money. It's another day in New York City. Let's get this
oh my
money.
gosh.
It's another day in New York City. Let's get this money. It's another day in
Yeah.
New York City.
So yeah, again, it's again like this is the last thing. It's a bit more of a joke, but again, for someone to engage and like for someone who is a bit notorious, who does, I'd say you can of course like come to a conclusion, but I would say that he does know what he's doing to a reasonable degree. And again, the fact that he's willing to open source it. And the big thing about all these guys is that they are willing to not open source is the wrong term, but the fact that they are willing to be public and like be willing to talk and share without, and they're not selling a product, right? Like they might be just like doing it because like their own ego to build prestige, but they're not doing it to sell you a product. Matt Levine's newsletter is free. Howard Marks's memos are free. The Damodaran stuff is free, right? You don't need to be an NYU student and New York University Stern School of Business student to see it, to read it. This Shkreli stuff, free. So let me check it. I don't want to miss any financial resources because who knows if I'll revisit this in a while. Yeah, since I'm at it, who knows? Maybe I'll be exposing myself. For China related stuff, assuming of course that you're probably not all that. Most of us probably can't read Hanzi too much. Pekingology is a very useful Substack where this wonderful, sincerely wonderful fellow does translates documents and things, or like he has access to like books that are or, like books that are being written in China that like you wouldn't otherwise hear about. For example, and again, like some of these things that he talks about, like just literally do not get any coverage. Certainly among like the big like U.S. Slash Western outlets, like the China's like global initiative. Like can I like there was no article about. It's like you just and again like of course like not going to like the actual substance, but again really good resource to just like get primary documents that you translated into a nice readable English format, right? Like again, readable format, right? Like, and he links to the original sources. So again, you can again just like again like you can tell how serious or credible someone is if like to actually like provide like the sources. And just as there's like YouTube channels like some ordinary gamers who won't link to like the article that that they're taking the screenshots from or the screen grabbing from. Like it's and they won't just like put in the description, they won't put in the comments. That's a bit disingenuous and should say something up to you. Like and like stuff like he links to stuff. The Damodaran links to stuff. Matt Levine stuff, hyperlinks, uh, and so that's kind of a sniff test. Next resource is the Invest Like the Best in Business Breakdown podcast. Very useful. And they have started some like Web 3.0 stuff, but just ignoring that, right? Like business breakdowns, like just like talking about a company with somebody who knows a bit more of the company. Like they had like this, like the CFO of CBS or I guess technically Paramount. I forget the distinction, right? But like again, like you can listen to podcast format. You can, and the really nice thing though, they provide the transcript. So if you want to search through the transcript for specific words or to save time, then it's really helpful. And again, all again completely free. And it really is like, and I think the good thing about these podcasts by Patrick O'Shaughnessy and like Jesse Pujji and the team is that, especially when it comes to the invest like the best, I think it's too much of a lot of investing discussion can be very binary. Like, will this go up to into the right, or how can I make money? I think a good thing about his podcast is it actually takes a step back to actually think about fundamental like first principles, why like different like perspectives and philosophies on how markets work, why businesses work, what makes a good business, and like on a fundamental level, and that's really helpful, and I think is something that often goes miss unspoken, certainly with like say like a CNBC perspective. And so honestly, I think those are kind of again to that more Substacks that are free, more newsletters that are free, but I think for the context of this video, they did pivot from looking at the motor into specifically. I, of course, pivot. Be flexible and broaden the context. Um, to I was tempted to talk about. I'll be honest. I was tempted to talk about why Steam is 30%. Why if you want to criticize the gaming industry or something like the large tech video game publishers, why you want to criticize them? Why if you're going to criticize them, then you have to criticize Valve and Steam's 30% take rate, just because, right? That's part of COGS, cost of goods sold. And if your cost of goods sold is that much, is 44%, right? Then imagine if that 44% is not as high, you can reduce it by 30%, and how much more money there is then. Because again, video games are expensive projects that take time, right? Again, hurdle rate, volatility, risk. It's not guaranteed outcomes. And so if your income structure is a bit challenged, then of course you're gonna be more hesitant, be less innovative. Um, Anyways, it's a different video idea. Let me know in the comments if maybe I'm talking out of my head. But anyway, again, really quickly, Professor Damodaran. Again, and again, all of these will be linked in the description. Again, highly recommend. Again, like everything that I've talked about here is free. Even again, Wall Street Journal. I think the Wall Street Journal has the horrible affliction of presenting opinion as fact. They have the horrible that horrible condition. Nothing you can do about it to cure that for the Wall Street Journal. But I will say, like, I'm not signed in, right? You can just go to the search bar and just look up the company ticker. You wanna, of course, there are limitations. Like, unlike Cap IQ, which unfortunately costs too much, like like they won't, like you can't convert directly like the currency, right? But it's very useful certainly for U.S. companies, uh, or like companies that like U.S. that transact in the, or like whose financials are in the dollar, right? And so it is very useful to, it beats Yahoo Finance, in my view, of just like if you want to just look at and like breaking out percentages of what your gross margins are, and those percentages are useful. It's good. So Wall Street Journal, I'm not gonna link to the Wall Street Journal, but again, like just looking up companies to get like a consolidated view of the three financial statements, very useful, as well as miscellaneous like shares outstanding is useful, dividend yields, dividend is useful, short interest. I don't know, less useful, unless unless of course you're a short squeeze or whatever, right? But Damodaran again, completely free. Just like general commentary that about basic fundamental principles that are good to know, good to be reminded by, and done again presented in a very clear, concise way that is helpful and useful. Howard Marks, again, it's like very clear, concise writing that conveys points, and certainly given his like at this point 50 years of experience, it uh, it kind of in a sense like time is like just like if a song is still popular 50 years later, then it's it's past the test of time, then the time has arguably shown like it allows him to identify like core themes that are consistent, just like the market cycle, just like how like there's euphoria, there's also excessive fear. And so those principles are good to read. Matt Levine, I'll link to that again. It's just like read like funny, very like intricate cases, or he explains things like complicated financial products or like bankruptcies or transactions in a way that is understandable and again in a funny way. Warren Buffett, Charlie Munger's Berkshire annual meetings, again, just like it's are Charlie Munger and Warren Buffett a bit overhyped? Maybe, but again, it's like to be very public, willing to talk and answer questions. It's like a rarity. Again, Martin Shkreli, hey, he's back, and he's an interesting guy. And so again, but again, right, like he's willing to engage, right? Like he doesn't know these guys, and he's engaging with them. He's into his spaces. Like like yesterday, he was oh, he doesn't make them public. Oh, that's a shame. But his streams are live, and like yesterday, he was like literally like he was modeling GameStop, and he was literally taking questions from like all these people who are like hyping up GameStop or like talking and are potentially like a bit outlandish ways about GameStop, but it's and then Beacongology again, very useful. The Chinese primary documents to you know instead of going through a middleman, you can actually get to the primary source, or again, just like read things that you again like you just would literally never read. I don't think any Western publication would have a would take a Ren Zhengfei interview because the founder of Huawei or some of these things, and then Colossus. Again, just like from more like conceptual, higher level view of what investing really is about. Um, So all of these useful resources are very helpful. All of them will be linked in the description. And so check it out, subscribe. Again, they're all free, all completely free. And so on the way to end it.
My phone, bitch.
Wow.
Yeah.
Maybe I have a deep voice because I'm in the shower right now.
I don't really give a fuck what you're doing. It's $100 to talk to me right now. It's another day in New York City. Let's get this money.
So I think it's really disingenuous. I said, that's right, I'm a maricon. Absolutely. I'm the biggest, baddest maricon in this place, bro. So watch what you say to me. You got that?
On that note,
Try to learn
again,
Spanish.
highly recommend checking out these various, again, free resources that are out there. Of course, all of them will be linked. But thank you for watching. And again, sincerely, like if there's like a newsletter, a Substack, or resource that you go to that you think it is really useful and others will benefit, like please like put in a comment so I can read about it and so others can also. Because again, ultimately, there's no downside to reading more. So thank you for watching. Thank you for listening to the stream. And again, please check out these various resources that again are completely free. Nobody gets anything from you signing up for the email list or any of that. Thank you for watching.